Now we're going to look at the journal entries that go with this. Now for every fixed asset, we have uh, we have three different accounts that get associated with them. The first one is the actual asset account. So like car, plant, equipment. This gets set at the purchase value and never changes. The second one that we have, that we will always have, and basically all we do is we take the asset name and then we add words to it. So for the first one, we need what's called a contra account to track the accumulated depreciation. So we call that accumulated depreciation, and then a dash, and then the name of the asset. So in this case, we're gonna say car. This tracks tracks all the depreciation amounts over the years. The other thing about this is the sort of the accepted short form for this would be ACC dot DEP dot and then the dash and then the car or whatever name of the asset is. The third account is the expense account, and so for this one we call that depreciation expense dash car. And this is used to hold very temporarily. It's to hold the depreciation amount for the current year. And it is an expense account, and this is where we put the money in order to put it against into the income statement for the year. And so we're going to need that. We'll see how that gets used. And then it's a temporary account. It's one of those temporary accounts that gets closed out during the adjustment process. All right. So as we know, anytime we have an expense, we are going to debit the expense account always. So that's what we're going to do. The depreciation shows how our asset is dropping in value. So that means this is always going to be a credit. And as I said before, the asset account itself never, ever, ever changes. So going back to our straight line method, then we have in the first year in the simple example we did, we had $3,000 in depreciation to keep track or to expense. So this is how the journal entries are going to look. So again, these are always going to happen on December 31st. These are part of our adjustments. So we're going to have our depreciation expense account is going to be first. And that, as I said, was $3,000. The next one we're going to have is our accumulated depreciation account, which is always the credit. And usually that's just a simple explanation. Like that. There we go. And so basically at the end of every fiscal year, we are going to process one transaction like this for every fixed asset that we have. So every individual car, if we bought them separately, piece of plant, equipment, warehouse, whatever all those durable assets are, if we had 6 of them, then we would have 6 entries like this. If we had 100 of them, we would have 100 entries like this. And so then what happens is, as I said before, this $3,000 in the expense account, it gets put against our revenue to calculate our net income or loss for the year. So that's putting that individual year's expense or use of that car towards the profit or loss. And then this goes to the balance sheet. Contra just means a simple or a different way of saying against. So we have the asset account, which has the purchase value. This is the total depreciation that we're putting against the car. And so we never really have the true book value showing on an income state or on a balance sheet. We show the purchase price, and then we show the accumulated depreciation. And that way somebody can see how much the original value of the car was, like how special or expensive the car was. And then based on how much accumulated depreciation is left, they'll know was it purchased recently, or was it quite a while ago? So that way they know both the value of the car and how old it is at the same time. So it kind of communicates more information. So that is it for our series on depreciation.